Flexible budgets. Flexible budgets restate the original budget calculations using actual current volumes. This restatement is then used to isolate the reason for the differences between the original budget and actual results. Rarely do budgeted volumes equal actual results. Therefore, restating the budget calculations in terms of the actual volume or a flexible budget can show what should have taken place based upon actual results. Comparing the flexible budget to the original budget yields a variance analysis which captures differences related to volume or activity. Comparing the flexible budget to actual results from the income statement yields differences related to revenue and spending variances. Let's look at an example so we can understand this. This is the original budget for a Treasury Services Department of a bank. This is what they expect for the month of May. They're expecting to see 1,000 clients, and they charge $200 per client. So with 1,000 clients, they're expecting revenue in the month of May to be $200,000. Now they have some variable expenses that vary in relationship to the number of clients they see. So the salaries have a variable component to it. So it's $80 per client, seeing 1,000 clients. So they're expecting $80,000 in variable expenses and an additional $2,500 associated with the fixed component of salary, which would be the manager of the department. Then they're expecting variable overhead in the amount of $5 per client. So with 1,000 clients, that would be $5,000. They have rent for the various facilities that they use throughout the bank. And then they have miscellaneous expense, which has a variable component, $3 per client. So 3 times 1,000 is $3,000. And then there's a fixed component of $360. So they're expecting net income in the month of May of $99,140. Now we have the actual results. So this is what actually took place in May. So we can see that they didn't see 1,000 clients, they saw 900 clients. So now we have the client fees from the income statement as well as these expenses from the income statement. And we have these different variances. We had $25,000 less in income than we were expecting. And then also we had less expenses than when we were expecting. So in order for a manager to be able to explain this, some of this difference should be associated with the fact that they saw 900 clients as opposed to 1,000 clients. By using the flexible budget, we can help to isolate that. So now let's look at how we calculate a flexible budget. The flexible budget would be based upon the actual volume. So it's 900. This is the flexible budget, 900. Now, instead of using 1,000 clients plus the fixed cost that we have here, we would instead use $900 and 900 clients rather, and the calculation for each one of these. So $200 per client times 900 clients is $1,800, $180,000. Sorry, guys. The salaries, they're expecting $80 per client as a variable component times 900 clients plus the $2,500 for the manager's salary would equal $74,500. And so you can see how each one of these would be calculated. Now, let's look at comparing the results and isolate the reason for the differences. So we want to isolate and figure out why we have these differences and explain them. So the first thing we're going to look at is the activity variance, comparing the flexible budget to the original. What can be explained by the changes in volume? Well, intuitively, you know that the fees or the revenue is going to be less because we saw 100 less clients. So taking the budget minus the flexible budget, we have a $20,000 difference. Now, this would be unfavorable because revenue is lower than what it should have been, but we can explain $20,000 out of this $25,000 by the fact that we saw 100 less clients. And so we would do the same thing for each. We would take the difference between the budget and the flexible budget. Now we see that expenses went down. Now that would be favorable because expenses were lower than expected. So when the volume that you're expecting is lower than the budget, then you would expect your revenue variance to be negative, but your expense variance to be positive or favorable because you spent less, but you also got less. So your revenue would be unfavorable. Now, if this had been 1,010 clients or 1,100 clients, the revenue variance would have been favorable. However, the expense variance would have been unfavorable because it was more than what you had expected. So now we've explained 8,000 out of the 6,500, 20,000 out of the 25,000, 500 out of the 1,000, and 300 out of the 110,000. Well, obviously there's an additional missing component that we need to look at, and that's going to be the revenue and spending variances. So now we've explained everything associated with the change in activity. So now let's look at the rest of it. So now they're looking at the revenue spending variance. So now what you want to do is look at what should have been based upon the flexible budget in comparison to the income statement. This is what should have taken place based upon the budget. So now we see that there's an additional $5,000 that we lost that's not explained by the fact that we saw 100 less clients. So this would be investigated. Because the income statement is lower than what it should have been, the flexible budget represents what it should have been in comparison to the income statement, this would be considered an unfavorable variance. Now, let's look at what should have been for the salaries. This is what it should have been. This is what it actually was. So $1,500 associated with the total $6,500 difference can be explained by the fact that salaries were $1,500 higher. We explained 8,000 of it, but adding the 8,000 together with the 1,500, we come up with a total of 6,500. So it should have gone down by 8,000. However, a portion of this is explained by the fact that it went up by $1,500, a portion of the 6,500. So it went up by 1,500. So this would be considered to be an unfavorable variance because it should have been $74,500 in comparison to $76,000. So this would be unfavorable. Now this says that the variable overhead should have been $4,500. However, it was $4,000. So this was lower than it should have been. So this would be considered a favorable variance. Additionally, this should have been $3,060. Instead, it was $3,250. So the fact that this is higher than what it should have been, this would be considered an unfavorable variance. So when looking at this, use common sense. When you're looking at the income statement in relationship to the flexible budget, look at what should have been in comparison to what was. Don't worry so much about whether these are negative or positive. Look at it and from a common sense perspective. So the salary should have been $74,500. They were $76,000. So that's going to be unfavorable. This should have been $4,500. It was $4,000. So that's going to be favorable. This should have been $10,000 and it was $10,000. And usually fixed expenses that are purely fixed expenses are based upon obligations, and rarely are there any differences unless there's some sort of escalation clause, perhaps in a rent agreement that you didn't take into consideration. Again, the miscellaneous, this is what it should have been. This is what it was. So it was $190 more than it should have been. So that would be unfavorable.